Welcome to Neko Hina's tutorial. Please like this video, comment, and subscribe.
Covered call ETFs are built for convenience, but that ease of use has a price. Most funds charge management fees, cap your portfolio's upside during market rallies, and trigger the highest ordinary income tax rates on every distribution. Managing these trades yourself changes the math. You keep the fees, select which strikes to sell, and dictate your own tax strategy. To replicate this at home, we will use the cash-secured put, the 4-step wheel strategy, and the poor man's covered call. Moving through these steps allows you to stop paying for prepackaged income and start generating it at cost. Most ETF wrappers are programmed to write call options on their entire portfolio every month. They do this automatically, regardless of whether volatility is low or if the market is trending sharply upward. This robotic selling creates a tax structure where distributions are taxed as ordinary income. In a personal account, you have the option to hold your underlying stocks for over a year, making the gains eligible for lower long-term capital gains rates. The first tool in this system is the cash-secured put. Instead of buying a stock at today's market price, you sell a contract agreeing to buy it at a lower price. In exchange for that agreement, you collect a cash premium up front. We can use Apple as an example. The stock is at $180, but you want to own it at $170. By selling a 45-day put at the $170 strike, you collect $4 per share. That puts $400 into your account immediately. If Apple stays above $170 through the expiration date, the contract expires. You keep the $400 as profit and can look for a new trade. If the stock falls below $170, you are assigned the shares. You buy them at $170, but because you already collected the $4 premium, your effective purchase price is $166. High option premiums often reflect high risk. Avoid selling puts on unstable companies or those in a clear downward trend just to chase a larger payout. Success with a cash-secured put depends on selecting a stock you genuinely want to hold. When used this way, the trade is a mathematical way to manufacture a discount on high-quality assets. Once a cash-secured put is assigned and you own the stock, the strategy shifts to managing those shares. The wheel strategy connects these steps into a continuous income cycle. In Phase 1, you sell the cash-secured put. When the stock dips to your strike, you are assigned the shares at the discount we just calculated. Now that you own 100 shares, you immediately sell a covered call against them. You select a strike price above what you paid and collect a second premium. If the stock rallies above your call strike, the shares are called away. You sell them at a profit, keep all the premiums you collected, and start the cycle over by selling a new put. This cycle creates yield in multiple directions. You are getting paid while you wait to buy the stock and getting paid while you wait to sell it. The primary barrier to this cycle is capital. Buying 100 shares of a high-priced tech stock often requires a cash position in the tens of thousands. The poor man's covered call is a way to run this strategy with significantly less capital. Instead of buying 100 shares, you buy a deep-in-the-money leaps call option that expires in 1 or 2 years. Because of its delta, this long-term contract moves similarly to the underlying stock. The capital difference is significant. 100 shares of Apple requires about $18,000. A single leaps contract with a similar profile might cost $2,500. You can sell short-term calls against that leaps contract just like you would with shares. You collect the same monthly premium income, but using only a fraction of the capital. This makes it possible to trade premium stocks without over-allocating your account or using margin debt. We have mapped out the 3 components of this blueprint: CSPs for entry, the wheel for yield, and the PMCC for capital efficiency. By utilizing these tools, you are effectively running your own tax-optimized income fund without the constraints of an ETF wrapper. To begin, identify one high-quality dividend stock that fits your long-term portfolio goals. Open an options chain and look for a strike price roughly 5% below the current market value. Calculate what your effective cost basis would be after the premium. Consistent income is a result of these calculations. Use the numbers you've gathered to evaluate the risk before moving on to the next module.
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then!